Okay. Good evening, good evening, good evening, everyone, and welcome once again to another round of educational series presented by Malls NYC. We would like to welcome each and every one of you here this evening to listen to our premium, and that is, in my opinion, premium professionals in law and accounting. And so let's say, why are we discussing legal structures right now? I will tell you for one of the main reasons is that everything is going to be professional if you're going to be making monies today. We are pivoting from storefront onto online. And when you come out from under mommy's protection of just being on this block and only people in this neighborhood know you, and now you're going onto the world wide web where you're highly scrutinized by any and everybody out there, including government. So lies are actually dying, even though people can still do some fraudulent things. But as a little baby out there in business, the attacks are really heavy against you. And that's the reason why we thought it's only fitting, as we are growing our businesses, to grow, to develop, to start, develop, grow, and scale to legacy brands, that you start your business right. And I know a number of you have said to me, I have my EIN number, I have my EIN number, I have my EIN, and that's okay, but we will find out from the professionals tonight if just having an EIN number, having your LLC, having your S Corp, having sole proprietorship, if that's really the way you ought to go and what comes along with it. Okay, so today we have dual presenters, and I would like to take this time to introduce them. We're going to start with ladies first, right? We are trying to be prejudiced here. Okay, so we're talking about Samantha Champagne, a CPA, and she's a partner in that firm. And her firm is, of course, located right here in Southeast Queens. Samantha is a founding member of the Champagne Dawkins CPAs, PLLC. Samantha serves as the business advisor for businesses and individuals, assisting them in matters involving taxes, audits, reviews, and compilations. Her clients include for-profit and nonprofit entities, providing consulting services that customize strategies based on the needs of each client. Prior to Champagne Dawkins CPAs LLC, Samantha was a vice president of finance at Goldman Sachs, where she specialized in accounting, performance, risk, and regulatory reporting in the United States and Brazil. Samantha started her career at Deloitte & Touche, where she worked as an audit manager who served as a key point of contact for client engagements. Samantha is a member of the American Institute of Certified Public Accountants and is, as a member of several nonprofit boards. Now we will speak of Thomas Farrell. Thomas Farrell, also known as Tom Farrell, has lived in New York his entire adult life. While trying to establish another career, Tom supported himself as a proofreader, a paralegal, and while working full-time with a Manhattan law firm, went to law school and graduated from St. John's in 1995. Early in his career, Tom practiced corporate and securities law, including serving as general counsel to 2 NASDAQ-listed companies. Afterwards, Tom's practice included regulatory compliance, licensing, HR policies, a broad and deep range of contract negotiation and drafting. More recently, he was general counsel to a niche recycler in Eastern Long Island. With the closing of that business, Tom has decided to bring his skills and experience closer to home, establishing a solo practice that's targeted to small and mid-sized businesses. Throughout his career, Tom has also done pro bono work, both for his church and for various small not-for-profits, including sitting on the board of directors of 2 not-for-profit educational organizations, for one of which he was chairman of the audit and finance committees for 3 years. Tom has been married for over 30 years and has 3 beautiful daughters. that said, ladies and gentlemen, I introduce to you Samantha Champagne and Thomas Farrell. Okay.
Thank you, Winnie.
All right. So feel free to go on, guys, and knowing that you will be spotlighted as you speak. And when you're ready to share screen, you already have access to doing that. So at the bottom of your screen, there's a green arrow that says share screen. So you can share your screen from there if it pops up.
Do you have it?
There you go. Very good. Very good.
Good, good, good. Hang on a second. All right. Good evening, ladies and gentlemen. Winnie, thank you for that wonderful introduction. Very,
You're welcome.
feel very at home here.
You're
Samantha, it's a
welcome.
pleasure to be here with you too. I'm really glad to have somebody taking the heat off when it comes to the tax and accounting questions. Tonight, we're going to be talking about legal entities for doing business and some topics that are related to that. As Winnie indicated, my practice is targeted to the owners of small and medium-sized businesses. In 2016, which is the last year for which we have accurate information, there were almost 31 million small businesses in this country and only 19,600 some odd large businesses. So almost 31 million small businesses, fewer than 20,000 large businesses. So when people say small business is the backbone of this country, the numbers bear it out. And of those 31 million small businesses, almost 25 million of them had no employees. It was just the sole owner. And then the rest of them did have some paid employees. So it is a lot of us, folks, just like those of us that are here, myself, Samantha and her partners, small businesses that are the backbone of this country, that are the engine of the economy. And I think the organizations that are going to pull us through this outrageous mess that we're in with this pandemic. Tonight, we will start by talking about legal structures, including sole proprietorships, partnerships, corporations, and LLCs. We start with sole proprietorships because they are the easiest to form and the cheapest. All you have to do is fill out a certificate that's called a certificate, a DBA, doing business as, and file it with the county clerk in whatever county your business is headquartered. The filing fee is only $125, and that's pretty much it. So it's easy, fast, and cheap. It is also, as you can see, in my opinion, the most dangerous because a sole proprietorship does not form a separate legal entity. So there is nothing between the business and you, which means that if something goes wrong in the business and the business gets sued, your personal assets are at risk because there's no wall between them, okay? If something goes wrong with the business, everything you have, your bank accounts, your car, your home, is at risk if the plaintiff suing you is successful. Now, as I understand it, though, there's at least one advantage when it comes to taxes, which is the New York City unincorporated business tax, right, Samantha?
Correct. So, good evening, everyone. My pleasure to be here with you all this evening. Tom is correct. There are benefits on a taxation standpoint for sole proprietorships. One is the tax rate itself that is charged for sole proprietorship. Typically, on the federal side, there is no taxation for a sole proprietorship, and there is a Schedule C that's included in your personal return, and your business then gets taxed at whatever your personal income tax rate is. And that tends to be a benefit for sole proprietorships. Additionally, on the New York City side, typically if your gross receipts do not exceed $95,000, then the New York City tax doesn't even come into play. However, if you have multiple businesses, you will know that all the businesses are combined when that $95,000 is being calculated. So again, for really small businesses, the sole proprietorship on a taxation standpoint tends to be beneficial. But legally, there are challenges there because, as Tom mentioned, there's no segregation or separation between yourself and the business.
Okay. Winnie, do you want to take questions as we go along, or we're going to wait to do all the questions at the end in the Q&A? You're muted, Winnie.
Yes, I would like everyone to jot down questions or even take screenshots. But if they can do that, we're opening up pure Q&A at the end because we find out that it can sort of delay the presentation.
Got it. Okay.
Well, okay. And also to put their questions in the chat in case they have the questions and they don't want to forget it, type it in the chat. We will scroll through that. Okay.
Sold. Okay. The next form of legal entity that developed for business is partnerships. And essentially there are two different kinds of partnerships. There are general partnerships and limited partnerships. In the general partnership, each partner is liable for all of the debts and obligations that the partnership runs up. So if Samantha and Winnie and I formed a general partnership and we each put in $10,000, and then that general partnership ran up $100,000 worth of debt, each one of the three of us would be responsible for that entire $100,000, okay? Now, in theory, because each partner in a general partnership gets a vote, we can steer clear of that kind of mess. You know, you got a chance to say how things are going to be done, so you try to avoid running up that much debt. But if it does happen, you're responsible. Each partner is responsible for all of it. In a limited partnership, there's only one general partner and any number of limited partners. This is the kind of structure that people sometimes are thinking about when they talk about a silent partner, because in a limited partnership, only the general partner is, well, first of all, only the general partner is responsible for all of the debts and obligations. The limited partners are only responsible to the same amount of money that they contribute, their capital. So again, if Winnie and Samantha and I formed a limited partnership and I was the general partner, we each put in $10,000 and racked up $100,000 worth of debt. Each of Samantha and Winnie would only be responsible for $10,000 because that was the limit of their contribution. And even though I only put $10,000 in too, because I'm the general partner in the limited partnership, I'd be responsible for the whole thing. So limited partnerships have a little bit more flexibility. They allow people who don't have expertise in a particular area to invest with somebody who does. That's where limited partnerships come in handy. You'll see sometimes in both the entertainment industry, in the real estate industry, where it takes a lot of capital to get something done, and you have only one person that has experience or expertise in that area, a limited partnership will be formed so that a lot of people can put in a small amount of money to raise all the money that needs to be raised. And then one person, the general partner, runs the show. So instead of having to raise $350 million to make a movie from one or two people, you can raise it from 100 people and just have the one general partner who knows what he or she is doing in that industry running the show, okay? A limited partnership agreement has to be very detailed for two reasons. First of all, you have all those limited partners in there, so you need detailed instructions and guidelines for how they're going to get along with each other. Who's going to be responsible for what if the general partner is going to delegate some authority, okay? And it usually almost always has to address certain tax consequences or tax options because, and here I think Samantha will correct me if I'm wrong, with a limited partnership, there are certain default rules in the Internal Revenue Code. So if you don't change them in your partnership agreement, the IRS is making decisions for you. Is that correct, Samantha?
Yeah, that is correct.
Okay.
And this structure is not as popular for small businesses. Like Tom mentioned, there's certain industries where this is more prevalent, mostly in, passive types of investments like real estate or in film production, in areas where a partner is trying to raise capital. They're going to do most of the work and the remaining partners are going to be silent. Is it time for the taxation discussion, Tom? Are you done with the legal part?
I think, just let me mention the filing fees, please, Samantha.
Sure.
The original filing fee for a partnership is small. It's only $250, but there's a publication requirement with limited partnerships, just the way there is with an LLC. And so we're going to talk about that part later. And as I said, because the partnership agreement has to be fairly detailed, that can get expensive too. That does it for me, Samantha.
Okay. So from a taxation standpoint, partnerships typically file Form 1065. There is not normally tax at the partnership level. The partners pay taxes based on their prorated share of the income or losses. If they have a loss, then they get that prorated amount as well. And a partner would get a K1 from the partnership, which would indicate its allocated share. This tends to be a benefit for most individuals who have a lower tax rate normally than if it was taxed, like any business that's taxed at the federal level. There is the partnerships have in New York State a filing requirement, which is an IT 204. This is a filing fee that is filed with New York State. Sometimes it gets overlooked, but it's an annual filing requirement, and the minimum is the $25. Otherwise, there's a scale that you're charged based on your prior year's income. For New York City, the forms that are filed, the NYC 204 or the 204 EZ, the tax rate here is 4%. And I just want to mention something here that if you have an LLC, and it's going to come later when Tom talks about LLCs and their structure, but LLCs with multiple members are typically taxed as a partnership. So if you formed an LLC and there's more than one person in it, then your tax return looks as if you have a partnership. The default, if you have only one person in an LLC, is they're taxed as a sole proprietorship. So that's a distinction just based on how many folks are involved in your LLC. For tax purposes, the LLC gets disregarded, and it's treated based on a few different options, one of which is a sole proprietorship if there's only one, or a partnership if there are multiple people. There's another option that we'll talk about a little later in the presentation.
Oh, Winnie, now you know I wanted Samantha to be here tonight. I didn't know any of this.
Yeah, that's right. That's why the interlocking is important here.
Okay, so now we come to corporations. We had sole proprietorships, then partnerships developed, and then corporations developed. A C corporation is what you get as soon as you form a corporation. By default, in other words, you file a certificate of incorporation with the New York State Secretary of State, you wind up with a C corporation. If you want it to become an S corporation, you're going to have to take another step. We're going to talk about that in a little while. The advantages to C corporations are that you can have an unlimited number of shareholders. There are no restrictions on the type of shareholders that you can have as opposed to S corporations. And again, we'll talk to that in a little bit. And there's more flexibility with capital structure. Now, I want to talk for a minute here about capital structure because it's the kind of thing that can come up and bite you in the, well, let's just say bite you if you don't set this up properly. Capital structure in a corporation means the number of shares that the company is authorized to issue. In New York State, due to a holdover of practices from decades past, the large majority of corporations are formed with an authority to issue 200 shares. So if you think of those 200 shares as being the shares in your bank or in your vault, okay? Every time you issue shares to somebody to make them an owner, it has to come out of that 200. But it's important to remember that ownership of a company is determined by the number of shares that is issued, not by the number of shares that's in the vault. So if you issue 10 shares to person A and 10 shares to person B, they each own 50% of the company, and you still have 180 shares left in your vault. The same as if you issued 100 shares to A and 100 shares to B, because the percentage is determined by the number of shares that are outstanding. And we'll come back to that again later on tonight. The difference in capital structure with C corporations and S corporations is that in a C corporation, you can have different kinds of shares. You can have common shares and something called preferred shares. Common shares get to vote on corporate matters, including the election of directors. Preferred shares sometimes do also, but sometimes not. Common shareholders get dividends when there is enough money to go around after all the company's expenses and deductions. In other words, usually only if there are profits. If you have preferred shares and they are preferred as to dividends, for example, the company may wind up owing a dividend every quarter to the shareholders, whether there's money for it or not, and those dividends will accumulate. So if you had, for example, a $10 quarterly dividend preferred shares, then every 3 months, the company would own $10 on each share. And if the company didn't have any money for a year, then at the end of the year, it would owe each of those shareholders 4 quarterly dividends or $40. That's a preference. And all those shareholders have to be paid off before the common shareholders get anything. And there are different kinds of preferences. If we have time, we'll talk about them later. So you can use different kinds of preferred shares to attract investors, but you can only do that in a C corporation, not in an S corporation. The biggest problem for owners is that there's double taxation on a C corporation. So in other words, if you've got a C corporation and some money comes into it, the corporation pays money right up here, okay? It's taxed at the corporate level. And then if there's enough money to go down to the shareholders and it's distributed to the shareholders pay tax too. So the money that comes into a C corporation is taxed twice. And here we go. Samantha's going to give us a little bit more detail about that.
Okay, so the correct, as Tom mentioned, this is the first entity we've spoken about since we started the presentation that actually pays federal taxes. And this actually, the 21% rate that is currently being charged to corporations, to C corporations, was one of the changes that the last administration put in place in 2017. Prior to that, corporations were paying up to 35% as their taxes. So this is one of those structures where the corporation pays a tax, and also the officers will pay a tax, and this is the double taxation that Tom mentions at the federal level. For New York State, there is a franchise tax that is charged, and this tax is based off of, there are 3 different bases that the tax, and it's the higher of a few different calculations that you'll actually be charged. One is based as a percentage of your income. One is based as a percentage of your capital. And the final one is a fixed tax that you are charged. If you have neither of the two, then you are charged a minimum tax. For New York City, the tax rate ranges from 6.5% to 8.5% of your income. Unless you're in certain industries, for example, manufacturing and technology, those industries tend to have a lower tax rate because the city is trying to attract those kind of businesses back. But otherwise, you will find yourself typically in that 6.5% to 8.5% range.
Okay, is that it, Samantha, for now?
Yep.
Okay. All right, so C corporations. I guess one of the things that I neglected to mention, because sometimes I just forget because I've been doing this for so long, is that a corporation, like a partnership, is a separate legal entity. So it gives you that kind of protection you're looking for when you want to keep your business assets separate from your personal assets, and also put a wall between them so that there's no liability. So if you have a C corporation or an S corporation or a partnership, you've got a separate legal entity, and it puts up a wall between the assets and liabilities of you personally. So in either case, a C corp or an S corp, if you get sued, the plaintiff can only reach the assets of the corporation, not your personal assets. They are nice and safe. Okay. So what is an S corporation? An S corporation was the IRS's response to small business owners who got tired after years and years and years of paying what they considered a double tax. they created this separate new entity, an S corporation. Because it is designed to help small business owners, there are certain restrictions on it, okay? It is restricted to 100 shareholders. It cannot have non-US citizens as shareholders, although there's an exception there that we'll get to in a little while. But generally speaking, an S corporation cannot have non-US citizens, and it must have only one class of stock. Remember before we were talking about capital structure, and when we mentioned C corporations can have common stock and preferred stock, an S corporation cannot. An S corporation can only have common stock. The good news is an S corporation, an S status, eliminates the double taxation. So that if you have an S corporation, when the money comes in, the corporation itself does not pay tax. The money goes straight through to the shareholders. Samantha will call it a flow-through entity and talk about that, I think. And so it's only when the money comes through to the shareholders and is distributed to them and they pay income tax, that's when the tax is collected, okay? Now, when we were talking about kinds of shareholders a minute ago, I wanted to point out that under the Tax Cuts and Jobs Act of 2017, S corporation shareholders can receive company-provided health insurance. That's a benefit. And the fact that it is worth money does not impact the shareholders. It's a tax-free benefit. And also up to $5,000 in child care benefits. Although, Samantha, if I've got the numbers wrong, you won't hesitate to correct me, right? If they've been changed.
I'll correct you.
Okay. But the best news is there's a provision under the Tax Cuts and Jobs Act by which an S corporation can create a trust and issue shares of the S corporation to the trust. And the beneficiary of the trust can be a non-US citizen. So indirectly, a non-US citizen can be a shareholder of an S corporation, but it takes some doing. There's some hoops to jump through, but if it's important enough, it can be done with an S corporation as of the passage of the Tax Cuts and Jobs Act. Now, to become an S corporation, you need to file 2 forms, and you have to file it by the 3rd day of the 15th month of the calendar year you want to be treated as an S corporation. So for most intents and purposes, that means if you're the calendar year starts your fiscal year starts January 1st, you have to file your S election by March 15th, okay? If you didn't start your corporation until June 1st, then you have June, July, you have until the 15th of August of that year to have the S election be good for your first year. Otherwise, it'll be good for the next year, okay? You have to file 2 forms. One with the Internal Revenue Service called a Form 2553, and the other with New York State called a Form CT6. Now, I think Samantha's going to give us some additional information about that, correct?
Correct.
Okay.
So I want to reiterate what Tom said about the filing of the state and the federal elections. There are some folks, they create a corporation and they do not realize that to get an S corporation, there is additional paperwork that needs to be filed. By default, when you create a corporation, it's a C corporation and it's subject to double taxation. Without these elections, you will not get the benefit of the flow through. And the flow through is filed when the S corporation files on its 1120S. The taxes then are not taxed at the corporation level. The officers will receive a K-1 and be taxed at their personal income tax rate. Typically, New York State waits for the IRS's approval of your S election before they do their approval. And many times when you try to file an 1120S, if it's not on the records of the state, they'll ask you to send them a copy of what you got from the IRS to allow you to use this form. On the New York State side, and I know I'm being New York State biased, none of the other states have their own rules. I'm just making an assumption by doing New York. There is a franchise tax that's due for each S corporation, and it's a sliding scale based on the gross receipts for that year. New York City also has a tax, and this tax again is in the range of 6.5% to 8.5%.
Samantha, when you say franchise tax, we're not using that word franchise in the usual sense, right?
We're not. New York, once you are, you operate in New York or you're formed here, they expect you to file irrespective of if you have activity, which is one of the other things actually I'm glad you asked that question, Tom. When you have a corporation or any legal entity at all that you formed, even if you have not yet conducted business, if it's in the early stages, you are still expected to file a return. The return should be filed saying that you were not active and it was, you were ramping up or whatnot. But even if it's a zero, the expectation is that you are going to file a return. And that's where that, franchise or annual reporting tax comes in, where every entity has to pay a minimum tax for being able to operate within the state of New York.
The privilege of living and working in New York.
Indeed.
Now, as Samantha and I mentioned, there are two different filings that have to be made. The first is the Form 2553, which for some reason I cannot get to be reproduced on a PowerPoint. I just can't import that image for some reason. Here is the New York State form. It's called the CT6. This is the New York S election, and this is what has to be submitted to the Tax and Finance Department in Albany. This CT6, not this one. This is
Oh, right now.
this is a Cadillac CT6, folks. Wrong one. Use this one, please. Not this one. I'm sorry. This is what passes for lawyer humor. Okay. So now we've talked about partnerships and corporations, and we get to limited liability companies. And I saved limited liability companies for last for a reason. And Samantha will bear me out here too. Like a corporation or a partnership, an LLC is a separate legal entity, and it will give you the same kind of legal protection from liability if something goes wrong. The good news about LLCs is that they're simplest to form, except for that publication requirement, which we're going to talk about in a minute. It's very simple. It is nothing more than the name of your LLC, and the LLC is going to be headquartered. And if it's going to be of limited duration, in other words, if you're going to form an LLC that's only going to last 10 years or 30 years or whatever, say that right there on that one page. You ship it up to Albany and you get filed, okay? The good news also is that if you want to change that cap structure, you do not have to make a public filing to amend it. If, by contrast, you have a corporation and you start out with those 200 shares and your business is doing so well that all of a sudden you're attracting lots of investors and you use up your 200 shares and you need more, then you have to file something called a certificate of amendment. And by the certificate of amendment, you can increase the number of shares that the company is authorized to issue, 1,000, 10,000, 50,000, whatever. But that amendment is a matter of public record. With an LLC, you can introduce the units, increase, not introduce. You can increase the number of units that are held by your members just internally. You don't have to make a public filing, okay? Like a C corporation, there are no restrictions on who can be a member and no restrictions on the number of members that you can have. And I believe, and Santa will clarify this for us, it almost always gets the kind of flow through tax treatment that an S corporation gets. Now, the bad news is this stupid publication requirement. What this publication requirement means is this: in New York State, when you form an LLC, you are required to publish a notice for 6 consecutive weeks in 2 different newspapers, one of which has to be a weekly and one of which has to be a daily, and both of which has to be published and distributed in the county in which you do business. You have to pay for these notices, and the bad news is, well, I guess I should say even worse, you don't get to pick the newspapers that you publish in. You have to go down to the county clerk, and the county clerk keeps a rotating list of all the newspapers that publish this kind of stuff. And whoever's at the top of the list, when you go down to the county clerk, that's who the county clerk tells you to publish in. So if you go down there and it comes up that you have to publish in the Daily News or the New York Post, or maybe even the New York Times, if you're headquartered in Manhattan, it's going to cost you a significant amount of money. Even if it's not one of those big publications, the publication cost can be pretty significant. I generally tell my clients that it adds at least $400 to their costs of getting started, because in addition to the publication itself, you have to get an affidavit from each of those newspapers after the publication process is complete, and you have to take those affidavits and send them up to Albany and get them filed, and that's another $50 filing fee. And then you have to pay for copies of the affidavits. It's another, I mean, it's just one cost after another. It frequently costs between $400 and $700 to get to the publication process. So that's one of the reasons I'm really not thrilled about limited liability companies. You must also have an operating agreement. The operating agreement is the document that it's the internal rules of the limited liability company. It tells you how things are going to be governed. And because a limited liability company is kind of a hybrid between a partnership and a corporation, it has elements of both. The limited liability company's operating agreement is also a hybrid. It's a hybrid between a partnership agreement and a shareholders agreement, with some elements of these corporations' bylaws thrown in too. So an operating agreement tends to be complicated, just like the partnership agreement. It has to address certain tax matters. It has to address what happens if one of the members wants to retire or withdraw. It should address what happens if one of the members wants to sell his or her interest, or somebody approaches the member and says, you got a great company here, I want to buy your interest, I want to buy your share. Well, what rights does the company have? What rights do the other members have? So a lot of this stuff has to be addressed in an operating agreement. As I said, it makes it somewhat complicated, so it becomes expensive to have it prepared, okay? I'm going to skip the next part about how an LLC has to elect to be taxed, because I'm sure Samantha is going to cover that much more adequately than I would. But in terms of restrictions on transfer and apps in the LLCL, which is the limited liability company law, these two things go together. There are restrictions in transfer which are not like the restrictions on shares of a corporation. I don't know why they took certain parts of the business corporation law and imported them into the limited liability company law, and other parts they left out. So there are a lot of restrictions on the transfer of interest in an LLC. And if you want to either reduce or amend those restrictions, you have to put that in your operating agreement also. The limited liability company law does not address certain things that corporations have a long, abundant history of addressing, such as dissolution. When you come to the end of the LLC's term, or if you just, the business is either done and you've made all the profit you can, or the business is not working at all and you want to dissolve the LLC together, the law doesn't say anything about how dissolution should be accomplished. It also doesn't say anything about something called a derivative right, which means that if one of the members or one of the directors of the LLC has been hijacking corporate opportunities and the LLC has been injured, well, if you've got a corporation, the shareholders can sue on behalf of the corporation. It's called a derivative lawsuit. But if you've got an LLC, there's nothing in the statute that says you can do that. So you're really being deprived of a remedy in case one of the members is taking opportunities away from the LLC. So between the costs of the extra cost of forming an LLC, the extra cost of a detailed operating agreement, the restrictions on the transfer of interest in an LLC, and these gaps in the limited liability company law, unlike most of my accounting and finance colleagues, I am not a big fan of LLCs. I'm freely admit that I'm in a very small minority here. I much prefer the S corporations, but now I'm going to yield the floor to Samantha so she can explain probably why I'm wrong.
Well, I can't speak to the legal. I can see why, based on the gaps, you have a preference on the S corporation. The LLCs though are super popular. This is one of the structures that a lot of people form, and I think they form them sometimes not fully understanding what it is. I mean, there are benefits. It's flexible. It allows you to do a bunch of things. A corporation, Tom, you would agree with, it's a more formal structure. So a lot of times you have to have resolutions and documentation when decisions are being made that a lot of times the LLC will kind of waive some of the resolutions and the paperwork behind certain things. So, the flow through is one of the big things that people like, the fact that the LLC itself doesn't pay taxes, but it's paid at the rate of the individuals that are involved. There are these steps along the way, though, like you were mentioning, that sometimes get overlooked. The publication is really one of those. And, I've seen instances where clients have formed the LLC, but they didn't do the publication and they went to do a transaction and couldn't move further because they were not considered fully formed. And it depends on who you use to form your entity that will walk you through the process. So some folks will walk you through and say, once you've done this filing with New York State, you have to do the publication. Even with a corporation, some folks will set up your corporation but not advise you that you need to do the S election. So it's important who you use to form your entities, somebody who's knowledgeable enough to make sure that you complete the process. And in terms of taxation, what I was alluding to earlier is these LLCs also have flexibility in how they're taxed. You can be taxed as a sole proprietorship, which is the default when you set up an LLC and you're the only person in it. If you have more than one person, it's treated as a partnership. You could also choose, though, to be taxed as a corporation. And with a corporation, sometimes the benefits there is, and with corporations, when it comes to taxes, one of the things that officers need to be aware of, corporations, when their officers work for the corporation, they are expected to do payroll. They're expected to compensate themselves what is considered reasonable salary. And reasonable is vague. There are no dollar amounts around it, but it's really looking at, if you had that job outside of this corporation, what would it pay you? I would say, that's a good estimate of what reasonable is. But even in terms of the LLC, even if you don't choose to be a corporation, if you work for LLC and this is what you do, this is how you're employed, even the way you file the return of the LLC matters. You will get a K-1 from your LLC, but where you put your earnings on that K-1 is a distinguisher in terms of how you are taxed. So if you have an LLC and you have not tagged your earnings as self-employment earnings, you won't be paying Social Security or FICA on that earning. And it actually came up as an issue during the PPP funding that we experienced for LLCs and corporations. Several of these entities, they were not able to participate and to benefit from the funding of the SBA because the officers had S corporations but didn't do payroll, or they had LLCs and they did not tag them as self-employment income. So if you're not paying the related taxes for payroll or the Social Security and Medicare costs on what you're earning, then it's not considered compensation. When you just get a K-1 and the monies flow through to you directly without any of those taxes being paid for as compensation, it looks like it's simply an investment. It does not look as if you earn a living from that. And that's the distinction that, it came to light a lot. One of the things that we do with our clients, we ask them, why did you pick the structure that you picked? Just to get a sense of what are they thinking. And a lot of times when you start digging a little deeper, you find out that the S corporation might actually be more beneficial than the LLC, because most people, when they start their business, this is what they plan to do long-term most times, and this is what they're going to earn their living. But all the additional things that happen with the LLC formation, the publication requirement, the additional costs that comes, a lot of times an S corporation actually works much easier than an LLC. But each entity has its benefits. But that's just something to know. Typically, you can be taxed three different ways, and you should speak with your advisor when you have an LLC about which one makes the most sense for you.
Now, Samantha, I'd like to ask a different but slightly related question, because you brought up the payment of Social Security and FICA and all those other obligations. My understanding is that if you've got a payroll operation like that, if you've got employees and you're supposed to be withholding state and federal income taxes and FICA and Social Security, you have to make some kind of report about that every quarter, I think. Is that correct?
Correct. So typically, and when you have employees, and even for yourself, but definitely for employees, you're expected to file a quarterly return. And the quarterly return pretty much is your reporting of what you've paid and what you've withheld and turned over to the agencies from your employees. Sometimes, based on the amounts, you may need to make deposits every week. Some deposits may be monthly, some might be quarterly, all depends on the size of your payroll. But at a minimum, every quarter, you are required to file a return for your payroll. And payroll taxes are one of those taxes, Tom, that it actually, even if you have a corporation, it pierces the corporate veil because it's a fiduciary tax that you actually collected from someone. So the fact that you've collected payroll taxes, if you don't remit it, the corporation does not protect you from the responsibility of turning over those taxes. There are two types of taxes that pierce the corporate veil, and it's the payroll and sales tax. Those are considered fiduciary taxes, and you're supposed to be just a conduit. So anything in those two, that space, if you're not paid, it becomes your personal liability to make sure that it gets remitted to the agency.
Well, that's good to know. Well, I guess, but when you say it that way, Samantha, it makes perfect sense, because what you're really doing is you're acting as an agent of the state to collect those monies, right? So you have to submit it to the state. Okay, that makes sense. That makes sense. Okay. I would like to spend a minute, ladies, if you don't mind, on this business of incorporating in another state. I don't know how many of you this has happened to, but I get this all the time when I'm doing this workshop elsewhere. Somebody sidles up to the entrepreneur. It's usually the entrepreneur's no good brother, or brother-in-law maybe. And he says, if you form your LLC in another state, if you do it in Delaware, you don't have to go through all this publication nonsense, and you don't have to pay all those fees and stuff. And they'll sometimes try to tell you the same thing about forming a corporation in another state. It's cheaper, so you don't have to worry about it. Ladies and gentlemen, that is absolute nonsense. I'm here to tell you it is not true. Because if you are doing business in New York State, you're going to have to jump through all the same hoops and pay all the same fees as if you incorporated or formed your LLC in New York State. Why? Because if you didn't, the constituents in New York State would be screaming bloody murder to the legislators up in Albany. They'd be wanting to know why a guy who formed his corporation in Delaware doesn't have to go through this publication process and lay out that extra $500 or $600. So the answer is he does. The person that, even if you incorporate in Delaware, Nevada, or wherever else it is, as long as you're doing business in New York State, you have to pay the same fees. So the question I frequently get when I tell people this is, okay, what do you mean by doing business? And unfortunately, there's no hard and fast answer to what constitutes doing business. I ask my clients to think of it as kind of a sliding scale. And the more contacts you have with the state, the more likely it is that you're doing business in this state. Now, this is an e-commerce issue too, because just because you have an online business doesn't mean you may not be doing business in more states than one, okay? This business about where you are doing business, it depends really on the amount of contact you have. So for example, if you're incorporated in New York State, but you have 4 customers in Connecticut and you're shipping goods to them on a pretty regular basis, you might be doing business in Connecticut. It depends largely on the dollar value. If you're only doing a grand total of $10,000 or $20,000 in Connecticut, that might not be considered doing business there. But if it turns out that one of those customers gets really big and now all of a sudden you're doing $100,000 of business in Connecticut, you're probably doing business there, which means that you should, as Samantha said earlier, be collecting sales tax now, and you may also have an income tax liability. If it turns out that you have four customers in Connecticut, and now you've got a half dozen in other New England states, you've got 2 in Massachusetts and 2 or 3 in Vermont, New Hampshire, et cetera, and it would be convenient for you to have a warehouse in Connecticut so you can ship your goods all throughout New England. Well, now you've got customers and a warehouse in Connecticut. And even if the dollar volume isn't great, now you've got 2 separate distinct kinds of contact. So that increases the chances that Connecticut is going to say, oh yeah, you are availing yourself of our structures and our customers. You're doing business here, you have to pay taxes and you have to collect sales taxes for us. So it's not a hard and fast answer, but like I said, it's kind of a sliding scale. And the more contact you have with a particular state, the more likely it is that you're doing business there. What does that mean for an e-commerce business? It means that within a fairly short order, if your business is successful, you could conceivably be doing business in 3 or 4 states all at the same time, 5 or 6 states if you're doing anything good. And each one of those states has its own sales tax requirements, and they likely have their own income tax requirements. And at that point, you have to call Samantha right away so she can figure out whether or not you have to file income tax returns in each of those states. This is one of the unfortunate byproducts of e-commerce. And I hate to be the bearer of bad news, but that is the case.
No, but Tom, you hit the nail on the head there. I get that question a lot about whether or not the entity shouldn't be filed in another state. And,
Okay.
you know, I tell them exactly what you say. I tell our folks, you know, if you incorporated somewhere else, but you're doing business in New York, you still have to do all the filings here. So incorporating elsewhere does not prevent you from having to do the tax returns and the reporting that New York requires.
Agreed 100%. I want to talk just very quickly about the registered agent. Some of you may have discovered that when you filed your corporation or LLC, the company that did it for you named itself as the registered agent. The registered agent is nothing more than a fancy name for mail forwarder, okay? Because in New York State, if you've got a corporation or LLC and it gets sued, one of the ways it gets served notice, called service of process. And in order to commence a lawsuit, you have to serve a summons and complaint on the person that's being sued. For a corporation or LLC, you can do that by serving the summons and complaint on the New York Secretary of State in Albany. And then the Secretary of State has to mail a copy of it to you in your corporate headquarters. A company that appoints itself as registered agent is going to be the address to which the Secretary of State will mail that service of process. That's pretty much the only thing that a registered agent does. It may also get some notices from tax and finance and other state agencies, but basically all a registered agent is doing is forwarding mail to you. So if you've got an address in New York State where you can receive mail, where you're getting mail on a regular basis, you don't need a registered agent, and you can terminate that service very safely.
I want to just add to that, Tom, that there are some entities, when you were formed, you might have used a registered agent, which might have been your attorney. And subsequent, we had an example of a client, their attorney passed away, and they never went back to New York State to change the address for the registered agent. And then there was a legal matter. So when they never got served, the documentation was never provided to them. So periodically you want to look to see what address you have on file for the registered agent and make sure that if something changes, you change that accordingly with New York State.
Correct. Winnie, if you have no objection, I do have a couple of slides from another presentation that I'd like to share here.
Sure.
Okay, and Samantha, please feel free to chime in if I'm skipping something, okay? Hold on a second, please. Okay, are you seeing? Are you seeing the accessibility slide, ADA and WCOG2?
Yes.
Okay, good. Winnie mentioned this as we were leading up to this event this evening, that there's some concern about unscrupulous lawyers suing small business owners for violation of the Americans with Disabilities Act. I hate to have to admit it, but it is absolutely true. And as I said to Winnie earlier, these are the guys that give the rest of us a bad name. They're using a statute that is supposed to benefit people as a sword instead of a shield. And I find frequently that they are suing small business owners, not only under the Americans with Disabilities Act, but various New York state laws that impose requirements on business owners, such as the kinds of questions they're allowed to ask on employment forms online, and other statements about who is eligible to apply for a job and who is not. And they're targeting, these unscrupulous lawyers are targeting mostly small businesses because they're thinking the small businesses either do not have the resources or the inclination to go out and get a lawyer and fight it off. They're much more inclined to settle a case like this as opposed to a Hewlett Packard or a Microsoft or a Wendy's or whatever that have the resources to fight them off. So I'm going to try and share a little information with you small business owners tonight to give you a little leverage against these guys if they come around your business. The Americans with Disabilities Act is a very broadly based federal law that requires places of public accommodation, which is also very broadly defined, I should say that as businesses that are places of public accommodation, to make those places accessible. And so you are probably all familiar with the physical accessibility devices that we have seen crop up more and more frequently in the past 20 years. Ramps, elevator lifts, wider door frames, et cetera, et cetera. If you are building a new building for your business or renovating an existing building, your renovations must be in compliance with the ADA standards. So that if, for example, you're putting in a new doorway, and this cropped up because what some business owners did was they put in a doorway that only allowed one person in at a time, or allowed one person in to get their temperature checked, et cetera, et cetera. And so they renovated the door space. Those renovations, strictly speaking, had to be done in compliance with ADA guidelines, which means, generally speaking, they have to be wide enough to accommodate a wheelchair. And there are other, there are regulations regarding aisle space inside a retail store and accessibility of things on shelves, et cetera, et cetera. Now, what some of these unscrupulous lawyers are doing are threatening businesses over their websites, saying that the websites are not ADA compliant. Now, as far as I am aware, the ADA has not, and neither the ADA nor its revisions, I think it's the ADAA, the ADA Amendments Act or something like that. Neither one of them has addressed or created accessibility standards for websites. There is a widely recognized standard. It's called WCOG2, Web Content Accessibility Guidelines. And this page that you're all going to get when the presentation goes out has a couple of links to information about that standard, okay? There are different kinds of accessibility provisions that can be built into a website, not just visual, but hearing related also. And there are, numerous sources, text alternatives, captions, alternatives for you to make it easier for users to see and hear content that's on your website. And so there are ways for you to make your website accessible. I urge you to implement them as soon as you reasonably can. Many of them are not that expensive, I am told. I'm in the process of having my website updated by my online advisor, my online marketing advisor. For those of you that have built a website recently, either with Squarespace or what's the one that starts with W?
Weebly.
Yes, thank you. There are literally plugins. There's a dozen or two plugins that you can use to make your website accessible. Now, if you get sued by one of these guys, don't ignore it. Either respond right away or go and find a lawyer right away. If you don't know where to find a lawyer to help you fight this stuff, I will say this. If you exhaust all your other activity, other alternatives, come to me or come to Winnie and she will send you to me. This is not my strong suit. I know my way around here a little bit and I can help you if you really need it. I would suggest first that you go to the local bar association of the county that you live in, the Queens County Bar Association, the Kings County Bar Association, wherever you are, and ask if they have somebody who's doing this work pro bono. There's a good chance that the bar associations are already aware of this problem and that they have some lawyers who are volunteering their services to help address it for small business owners. If you go to the New York City Small Business Solutions office on Sutphin Boulevard in Jamaica, they have a partnership with a couple of legal help organizations. And they also have a partnership with one of the larger law firms in Manhattan that does pro bono or low bono work. And so I would suggest if the county bar associations are not to help, your next stop be Small Business Solutions. As I said, you can get them, you find them online. The city organization. There's one office on Sutphin Boulevard in Jamaica. There's another office in downtown Brooklyn. There are 3 offices, I believe, in Manhattan. I don't know what's in Bronx and Staten Island. I'm just not familiar with them. But there are places you can go to get help. And if you want to take steps to protect yourself, and just by the way, if you just want to take steps to make your website accessible, there's plenty of information here to help you do it. Along the same lines, the Occupational Safety and Health Administration has rules and regulations designed to help you live up to your duty to provide a safe and healthful workplace. Every employer has an obligation. It's called the General Duty Clause. Every employer has an obligation to provide to its employees a safe and healthy workplace. You have an affirmative responsibility to seek out dangerous conditions or unhealthy conditions and correct them. More recently, we had the business of readmitting people or customers and workforce back after the initial outbreak of the COVID-19 pandemic. And so the OSHA, the Occupational Safety and Health Administration, put out this terrific booklet, this guidance on preparing workplaces. The CDC has one of its own. The New York State Department of Health has some information of its own. I particularly like the OSHA approach because the OSHA approach breaks down into levels of risk, the exposure that your employees may have. So in other words, those of your employees that have no contact with the public at all, they're either working on a manufacturing floor, they're working in a back office or whatever, they have a lot less risk exposure than those employees who sometimes are in the front and sometimes they're in the back, and they have less of an exposure than the employees that are always dealing with the public. So the people that are behind your sales counters, the people that are on your floor dealing with the customers, et cetera, they have the highest level of risk. And OSHA guidelines address that by giving you more protections and different protections to implement for them than they do for the other categories. I like the OSHA approach because it's nuanced and it recognizes that different employees have different levels of risk and exposure, and it addresses that. So that's my personal favorite. Samantha, are you hearing anything tax-wise about the obligations to provide a safe workplace? Any tax credits or incentives?
I'm not aware of any specific credits or incentives. I do know that the monies that the SBA released recently for PPP, that's one of the things that it can be used for, is for now, the latest round, you can use some of the funding to make the workplace safe, particularly since we're in this pandemic. So any improvements that you make, those costs can also be used as a part of the way you use the funds for it to be forgiven.
Okay, that's new, isn't it?
Yes, that's relatively new.
Okay, thank you. Okay, so we've brought up the issue of employees. I wanted we're going to start hiring folks. Winnie, how are we on time? Do I have a couple minutes to go through this, or do you want to go to the Q&A first?
No, we're pretty good. If you could just complete your whole presentation because we have quite a bit of comments or questions in the chat, and we are scheduled for 9 o'clock. So we just want you to get through this, and everyone should be taking their notes of their questions. So once we start, we can just flow straight through.
And Samantha, please feel free to chime in. Once I get going, I'm hard to stop. So don't be shy about it, please. Okay.
Okay.
And honestly, I'm used to doing this on my own. So like I said, please feel free to chime in. Okay, so once you start to hire some employees, there are additional responsibilities and additional regulations that you should be aware of. First and foremost, before you even start hiring employees, you're going to have a job application form. And there are a couple of things that you can no longer ask on the job application form. New York City's Ban the Box and Fair Chance Acts prohibit questions about either a criminal background or credit history background. You cannot do a criminal background check or credit history check until you have made what's called a provisional offer. In other words, you have offered the applicant a job. You say, listen, we like what you've got. We think we want to hire you. We just want to run a background check first. You have to get permission from the applicant before you can do that, okay? If you run the background check and something comes up and it has going to have an impact on your decision on whether or not to, go ahead with hiring that person, you have to give that person an opportunity to explain what it is. You have to take into account how recently that occurred, whether the person was, young and inexperienced and, making the typical mistakes that youths make, because there's a difference between doing something at 16 and doing something at 26. And you also, not least, have to take into account whether the criminal history has anything to do with the job that you are hiring that person for. And I use kind of an extreme example. If you are hiring somebody to do house painting, and it turns out that that person has an embezzlement conviction, that's really kind of irrelevant for purposes of whether or not you should hire somebody to paint a house, because they're not going to have access to funds and checking accounts, et cetera, et cetera. So the embezzlement conviction has nothing to do with the position you're hiring them for, and therefore it shouldn't be a consideration. Like I said, that's kind of extreme, but that's the kind of thing you have to be aware of with the Ban the Box and Fair Chance Acts in play. There is now also a salary history ban in New York State. This is fairly recent. You can no longer ask a potential employee what their salary was the last places that they worked. This is designed to remedy the pay inequities between men and women. Typically, almost traditionally, for decades and decades, women were paid less than men for doing the same work. So if a man and a woman came in to apply for a job, and the woman disclosed that she was making $40,000 a year, and the man disclosed that he was making $50,000 a year for the same job, an unscrupulous employer would say to the woman, we like you so much, we want to hire you, and we're going to give you $45,000 because we think that you're that good a candidate. And she thinks she's got a great job and that they're doing her a big favor, when in fact, they're paying her less money than they'd be paying the man for the same position. So in order to avoid all that, to avoid perpetuating that kind of inequality, salary history questions are now banned. If the applicant volunteers their salary, you're allowed to take that information. And you are allowed to ask what their expectations are. If you want them to give you a range or even a particular salary that they're hoping for, you can ask the applicant what they're looking for, but you can't ask about past compensation, okay? Obviously, you also need to not ask about race and religion, age, genetic background, pregnancy, and the new one in New York City, caregiver status. If as an employer you think, generally, let's face it, this mostly applies to women. If you think a woman is going to be too stressed or not be able to devote her full time and attention to her job because she's a single mother and she has 3 children, or because she has 2 children and she's taking care of her elderly parents, and you think that might affect her ability to do the work, you cannot use that information in making an employment decision. That is considered discrimination in New York City based on the protected status of a caregiver, okay? You must obviously comply with minimum wage, disability, unemployment insurance, and workmen's compensation laws regardless of whether you have a corporation, partnership, or LLC. Okay. Talking for a minute about unemployment insurance. You must, as the owner of the corporation or LLC, register with the New York State Department of Labor. You fill out a form, and then the Department of Labor tells you whether or not you have to have unemployment insurance. The answer is almost always yes. As Samantha mentioned earlier, you must file a quarterly combined withholding, et cetera, return. And you, oh, I didn't know this. Samantha, I'd forgotten about this. You have to file that electronically? No paper filings anymore?
Say that again?
The quarterly combined withholding and wage reporting, et cetera, has to be filed electronically now. They're no longer accepting paper filings.
Yes, the New York State website allows you to file them online, to do web filings.
Huh, okay. I updated my PowerPoint, didn't even realize it.
I want to mention one thing, Tom, that you mentioned on the workers' compensation, that the New York State Department of Labor on these quarterly filings, even if you didn't have an employee for a particular quarter, you are still expected to file these returns and say that you had none. The penalty for not filing a quarter is at least $1,000 when you should have filed. And if you file them late, you will be penalized for it being filed late. So these returns, the quarterlies, they should be filed whether you have, so if for some reason, for example, during the pandemic, some folks may have laid people off and they had no employees, you're still expected to file a return for the quarter and say that you had no employees. And workers' compensation is one of those things that you need to have before you even start to hire employees. There are waivers that are available to officers, so you can do a waiver where as an officer, you can have, you cannot have workers' comp, you can waive out of it. But those exemptions are things that you should put in place before you get your employees on board and you do payroll.
Got it, okay. Now, Samantha, you didn't know, but you have now backed me into what I call my true confession speech, okay?
Oh.
Here's the part of the evening when I make my confession, and sometimes I do it to my clients too. And this is what I mean. When you are first starting out, sometimes even for the first 2 years, and things are tight, money is tight, and it's, you're being stretched in a couple different ways. You may have to choose who you're going to pay first, because you can't pay everybody all at the same time. You may in fact have to choose between paying your lawyer and paying your accountant. I always tell my clients, pay your accountant first, because the work that I do, yeah, I know. I'm only going to say this once. I'm not going to repeat it. Okay?
It's recorded.
Oh, I'm doomed. Okay. Okay. Well, all right. It really is true, though. You need to have your books and records set up properly, because if they're not, that can really come back and be a pain in the neck. It can cost you a lot of money. It's a nightmare dealing with state agencies. You really need somebody like Samantha to set up your books and records properly and keep, maintain them and keep you on your toes. So like I said, the work that I do is important, but especially in the beginning, the work that Samantha does is even more important. However, if you have to choose between paying your accountant and paying your insurance people, you have to pay the insurance people first. Because if you don't have your insurance in place and something goes wrong, you can't fix it. It's too late. So the true confession is, and like I said, I'm not even going to admit saying this now, even if it is recorded. The truth is, in order of importance, it's insurance, accountant, and then lawyer. Okay. Oh God, you forced it out of me. Wait, I lost my place here. All right. Okay, we did that. Workers' comp. Okay. I think, as Samantha has already mentioned, every employer is required to have to have workers' compensation policy. It includes all employees, including part-timers and family members, includes the family members, even if they are not paid, okay? The function of workers' compensation insurance is to make workers whole for job-related injuries or illness without regard to fault. If you are injured or become ill on your job or as a result of your job, doesn't matter who is at fault, you are entitled to workers' compensation coverage, okay? And because employers are required to have this coverage, they get a notice from the insurance company that issues the policy, and they are required to post it in a prominent place so workers can see that they are complying with this requirement. The notice is very simple. It's a regular 8.5 by 11 inch sheet with 2 columns of very tiny print, one in English and one in Spanish. And it does little more than tell you that the employer has workers' comp coverage and name the insurance company and tell you when the policy expires, okay? There's an excellent source of information here, this employer's handbook on workers' compensation. It's on the Workers' Compensation Board website. It really is a great place to start getting information about workers' compensation. Okay, it is the National Labor Relations Board and the New York State Department of Labor that enforce labor laws. Now the New York City Commission on Human Rights has taken a hand too. The Commission on Human Rights enforces New York City's anti-discrimination laws, of which there are several, and various other wage and hour matters and labor issues, okay? The 2 most important, I think, and Samantha, chime in if you have additional information, please. The payment of overtime. Overtime must be paid after 40 hours of work in a week, and it is calculated on a weekly basis, not daily, meaning that even if you work 10 hours on Monday and Tuesday, so you put in 2 extra hours those days, if you're sick on Wednesday, you're going to drop down below the minimum, so you won't have 40 hours that week. If you are closed on Monday for some federal holiday and then you work the extra 2 hours on Tuesday, Wednesday, and Thursday, you're still not entitled to overtime because you haven't hit the 40 hours, okay? It's 40 work hours, not sick or vacation days. Okay, we'll come back to that if we need to. Section 7 of the National Labor Relations Act, which is enforced by the National Labor Relations Board, gives employees a lot of latitude to talk about their working conditions. And this particular section has been interpreted very broadly, not just recently, but over the past several decades, okay? Keep in mind now that overtime is only paid to employees, not independent contractors. And this is a place that employers frequently get tripped up because misclassification, if you're classifying and paying your workers as independent contractors instead of employees, that's frequently something that will get you into trouble with the Department of Labor, okay? And here's what happens. You're going to hear a lot of people say, I don't have any employees, I've got all independent contractors. This is particularly prevalent in the construction industry, but there are other areas too. I've had these guys working for me for 8 years. They're all independent contractors. I don't pay any of that extra taxes and withholding and stuff. It's too expensive. Well, that's great until somebody gets hurt. And when one of those guys gets hurt and they go to file a workers' comp claim and they discover that they're not entitled to workers' comp because they're not an employee, then they're mad and they go to the Department of Labor. Or they realize that they've been working 50 hours a week for the past 6 months and not getting any overtime. And they go to find out why they're not getting overtime. And again, they discovered that they're classified as independent contractors who don't get overtime. And they get mad again. And they either go to the Department of Labor or they go to a lawyer. I'm not sure which one is worse. So misclassifying your employees to save a couple of bucks is a very common practice. I strongly advise you against it. It is the kind of practice that you only get away with until either somebody gets hurt or somebody thinks they should be getting overtime, or, and this happens a lot, somebody gets laid off.
I'm going to jump in on that one.
What's that?
Yeah. I was going to jump in to say that happens quite a bit too when you lay them off and they file for unemployment insurance.
Right. And they discover they're not entitled to it because they're not employees.
Yes.
Okay. Yes. So, you might be saving a little money in the short run, but over the long run, those problems are expensive. And Samantha, the fines are expensive too, aren't they?
They are. I mean, they'll go retroactively to the Department of Labor and calculate what you should have paid for unemployment insurance. And the Workers' Compensation Board, those hearings are painful.
Yeah,
Um,
that's true. Yeah.
yeah.
And
I mean,
then,
like you said, it does cost a little bit more, but you pay a lot less than if you end up having to go to hearings, or the Labor Department gets involved.
yep, agreed 100%. Now this, just to come back to this section 7 for 1 minute, because it gives employees such wide latitude to discuss their working conditions, it specifically forbids certain policies. You cannot have a policy, for example, that prohibits employees from discussing their salaries. You can't tell a guy, hey, listen, don't talk about your salary because I'm paying you a little bit more than some of the other guys and I don't want any trouble. That's a violation of section 7. You cannot have a policy that prohibits employees from complaining about their supervisors or discussing your company online. And in many cases, because this section is interpreted so broadly, some of the language that these complaints used, I'm talking about online discussions, talking about their supervisors, talking about the owner of the company, talking about their spouses and ancestors in, let's say, unflattering terms. I mean, and they got away with it because the court said, oh no, this is protected by section 7. So it's not even worth having a policy telling people that they can't post online or that anything they have to say has to be approved. You're not going to get away with it and you won't be able to enforce it.
Okay, so we have about 2 minutes more and then we have to go into Q&A.
Okay. Let me very briefly then discuss the difference between an employee and an independent contractor. I've been leading up to this on purpose, okay? An employee is an individual who performs services and you control what gets done and how it gets done. An independent contractor comes to you and all you do is tell the independent contractor, this is the result I want. I don't care how you do it, just go and do it, okay? If you are controlling the way the work gets done, the order of business, where the workers getting their supplies, the method or manner in which they're installing things or the order of work, et cetera, the more control you are exerting, the more likely it is that that worker is an employee, not an independent contractor, okay? And as you can see here, there are different kinds of control. Behavioral control, like what we just discussed. Financial control means whether or not the person in question is offering their services just to you or to the entire market. If they're offering services to the entire market or several other companies, it's more likely that that person really is an independent contractor and not an employee, because an employee just works for you. If you determine the salary or the payment that the person is going to get, you're taking away that person's opportunity to determine their own profit. That means that person is much more likely to be an employee than an independent contractor. It is largely the amount of or degree of control that you exercise.
Well, Tom, I wanted to just add here, if I may.
Sure,
that,
please.
When you have independent contractors, and if they do not have workers' compensation insurance, it is your responsibility. So, when you use contractors, if they don't have their own insurance, it's something that ends up on your tab when you are reviewed for that insurance.
Right. Or if somebody gets hurt.
Yes.
As Samantha says, if somebody gets hurt and your independent contractor doesn't have workman's comp insurance, they're gonna put it through your insurance, which is gonna raise your rate.
Even if they're not hurt, when you're audited, so say for example, you have a policy with the New York State Insurance Fund, for example, and they come in to do your annual audit because they charge a premium based on your estimate at the beginning of the year. When they come at year end and they see that you issued a bunch of 1099s to contractors and these contractors didn't have insurance, it now becomes your responsibility to cover them. So even without incidences, they add that to your policy.
Wow, that can get expensive, I bet.
It can. And it's recommended that when you are getting contractors, that they provide you with some evidence, a certificate of insurance to show that they have their own And you can imagine how expensive that gets for contractors, because like you said, in construction, a lot of contractors label folks as independent contractors, and a lot of times they don't have insurance, and contractors end up paying for them when they're audited at the end of each year.
Wow. Well, that's good to know. That's very good to know. Winnie, I think Samantha and I are ready to go into the Q&A portion of the evening.
Okay, very good. I want to first of all thank Samantha and Thomas for an excellent education. I jot down endless notes here because as a consultant, I have to help my clients out. And I know a lot from the larger corps, but for the small, you don't know how far down it really came down to the smaller one, which is why I called both of you at the last hour and says, listen, we got to cover this because this is what I'm hearing out here. Okay, so is it possible for Samantha or you to bring up, first of all, how they can reach both of you, and then we can now just focus on the questions? Is it on the screen anywhere? And then everyone can use their phone or what have you to take a snapshot or write it down quickly. I know that's Tom's own, right? So get a snapshot of Tom's.
Okay.
Okay, hold it. Yeah, hold it on yours. Everyone gets a snapshot or just at least get their phone number down. All right, so I'll give you a minute to do that. And clicking, or maybe 30 seconds, right? And then we will do that with Samantha's as well, because we really have a lot of questions. Okay, that's Samantha's. Take a snapshot, write the numbers down. And as you can see, both of them are right here in Queens, making it very easy. Real great professionals. All right, so then when you're done, we could stop share screen and we can then bring, I hope we got here. Did I cut you off? No, I thought I cut you off. Very good. All righty. So we are back and ooh, look, now the screen is open. I can see everybody. Wonderful. Okay, so we're gonna start with some questions here. Ronnie has asked some questions, New York state tax being meant to be like sole proprietor, right? Ronnie, you were talking about, I don't know if that was answered, but that was your first questions. I'm going from all the first questions coming down. Was that?
Okay. Should I ask? Let's just read it.
Okay, all right.
Okay, cool. Yeah, because I don't think it was answered. First of all, thank you for your presentation. I have a lot of questions, but I'll start by thanking you guys. Great presentation, great teamwork. So my first question is, does New York State tax treat single member LLCs like sole proprietorships as well?
Yes, they do. They disregarded the LLC for tax purposes in New York State and New York City.
Okay. And does that mean that, so I remember you saying that they also, when you file your taxes, you have to put down how you want to be taxed. So if you put your income down as self-employed, then they'll just tax you at the self-employment rate, right? As an LLC.
So, right. So yes. So it depends on, right. You have to tag that income as self-employed income. And typically your, this is something that will show up in a self-employed earnings box on the K1, but that only applies to multi-members, not for a single member LLC. For a single member LLC, by default, you're gonna have a Schedule C, and that's it. And your Schedule C then will calculate whatever self-employment income comes along with it automatically. Only when you have a multi-member LLC where you'd be filing a separate form does that distinction need to be made to know how then that income flows through to your personal account.
Okay, perfect. Thank you.
Personal taxes, I should say. You're welcome.
Okay. I'm going to go down the questions as I see them to make it fair. I know Ronnie has most and then Wayne next. I believe Sonia asked, what are some general guidelines to turn a sole proprietor to a PC or LLC, and what are the benefits options? And Sonia, you can speak up in case I didn't get it correct.
Yeah, you got it.
Okay.
Okay, to turn a sole proprietorship into a PC, well, a PC is a very peculiar kind of corporation, because that's a professional corporation, and all the shareholders of a professional corporation have to be licensed professionals, and they all have to be licensed in the same area. So it's all doctors or all architects or all lawyers or et cetera. And that has a whole separate set of requirements that Sonia, a little bit beyond, I think, the scope of this presentation.
Okay.
But to turn into a regular corporation or an LLC, you need to file the documents that you ordinarily would file just to form a corporation or an LLC. And then to take the organization steps after that, getting an employer ID number, making an S election if you're going to, and then if there are assets that are held by the PC, you have to get some transfer documents so that if there are vehicles, I'm sorry, I said PC, I meant sole proprietorship. If there are assets that are held by the sole proprietorship, equipment, vehicles, a leasehold maybe, all those things, all those assets should be formally transferred to the corporation or LLC. And there are different kinds of transfer documents to do that.
Wow. Okay.
Very good. And you have his phone number, of course, and Samantha's, in case you have further questions and would like to be their client, right? Okay, another question?
Right, because because what I was saying is that I'm a bit confused because, okay, I'm a licensed clinical social worker. And that's why I thought about a sole proprietor to a PC, because I have the license for the profession, rather than going sole proprietor to LLC. I didn't know which one of those would make better sense for me.
I'm sorry, I didn't realize you had a license and we're asking a particular question about a licensed profession. So in your case, you're 100% right, Sonia. It does make more sense to go to a PC.
Okay.
And also
so-
the LLC has a professional entity as well, which is called a PLLC. So either of those two, like Tom was saying, though, there are some additional steps that need to be taken to get there, which includes then the New York State Board of Education, because that's outside of the scope of what we're talking about. But for you to actually have one of these professional corporations or limited liability companies, you need to get approval at another level also.
Okay, good. Thanks.
Wonderful. Okay, so Ronnie had another question. How does LLP work with raising funds from the stock exchange with angel investors? I don't know if that's above our level here, but.
Yeah, Ronnie, I hate to do this, but that's a complicated issue, and I think it's a little beyond the scope of what we're doing here.
Yeah, yes. Okay, Wayne had a question. Can you stay a C Corp but taxed as a S Corp? What forms are used to do that? Can you
So-
stay a C Corp but taxed as an S Corp? What forms is used?
So you can't be both. You have to make a choice in terms of which structure you would use. And by default, when a corporation is formed, it's considered a C Corp. There are extra steps that would need to be made to be given the favorable S election. So you'd have to make a choice. And then based on that choice, that's what taxes would become your profile. So you can't have both. I don't know if I answered the question there.
Okay. I think he says yes, he's muted, but I think he says yes. Okay. Ronnie had a question. Who would be the best one to manage the S Corp and other filings? Your accountant or your CFO or your lawyer? Ronnie
I
explained.
think either a competent lawyer or a competent accountant can manage the initial S filings, The tax work that flows from becoming an S corporation should be handled by the accountant, though.
Okay.
Agreed.
Winnie, I have to pause here and just remark, I'm shocked that Ronnie Summer is asking questions. She's usually,
Ronnie, if these are questions that you already know, let me tell you, you're holding up the time. Okay?
no.
You're holding up the
No,
time
I'm
for
curious.
others.
My background's in engineering. I don't know about any of this.
Okay, all righty. Wayne asked another question. If you file an LLC and didn't do the publication requirement, can it be done later? I believe the answer is yes.
Yes, the answer is yes. Do it as soon as you can.
Right.
If you take too long to do it, the state can actually dissolve your LLC if you wait too long.
Yep.
And also you do not want, before the publication process is finished, you do not have access to the New York State court system. So if, for example, you need to sue somebody because they didn't make payments on your contract, you wouldn't be able to do it.
Mhm.
I don't know what the other consequences are, Samantha.
The public, I mean, just certain transactions you can, like, you know, for example, I had an LLC was trying to buy a piece of property and they weren't able to close because they weren't considered fully formed. So
That's it. And I just want to tell you with my client, who is a very notable, well-established company, and based on what both of you just said, or I think Thomas says, their business could be dissolved. So I need to call them tomorrow, okay? Their accountant filed them just to get the LLC and charge $875. That's the going rate that most of my clients said that their accountant charged them, and didn't tell them that it was that important to do the publication because of the expense, not knowing a number of these issues that, you know, because I know it's new and maybe not every accountant is following, like Samantha stays up every single month knowing what's going on. That's why I send people her way. All righty. So there are not a lot of accountants that are staying up to date, and the rules are changing by the hour. And what ended up happening is that when I went to file the client for their state MWBE, it was rejected because the state says, I know you're not. And worst upon it, they need the original, here is the catcher, the original filing receipt. And the accountant had it and cannot find it. And now there is a block. So they had to go through the senator's office to try to override the requirement for the original filing receipt. So what Thomas was saying, if any of you have an LLC, double check, triple check that you have the original filing receipt. You have all of the documents from whatever, that the state is happy, because if the state shuts you down, it cannot, and I mean, 20 years in business and you're getting shut down because you moved from an S Corp or whatever other entity you are in to the LLC, and being told by your accountant, and that's a whole nother conversation, but I had to make sure Thomas speak about it because I'm getting too many LLCs, which are minority owned, and they are not in compliance. And it's no fault of theirs because they're trusting what's considered an accountant. All right, so forgive me if I'm on my hot horse on that because I'm so disgusted. All righty, thank you for sharing that. Ronnie's question, what sort of shares can you have with an LLC? I believe it was answered before, I'm not sure. What kind of shares can you have with an LLC? I don't think they're called shares, but.
That's correct. They're not called shares, they're called units, or sometimes called membership interests.
Yes. Mhm.
And one of the beauties of the LLC is that you can have any kind of shares that you can want. You can have, I'm sorry, here I'm saying shares, interests. You can have common, preferred, 2 or 3 different kinds of preferred. There's state advantages of the LLC is the flexibility that's available for the corporate structure.
Alrighty, I know Thomas faded there for a minute because of the internet. You know, he was losing some bandwidth, so it was slurring there. But I think we got the gist on that, right? Wayne asks, can you use a service for the publications requirement?
There are several, there are lots of options there.
Mhm.
Some of them actually are pretty, competitive in terms of pricing because some of the services, they use paper so much, they have a reputation and they get discounted pricing. So you definitely
Wow.
can utilize the service.
Okay.
And can you recommend one?
We get different, I could refer you afterwards if you want to, different people that we've worked with.
Mhm. Okay. Kenneth Brown, or Ronnie had one more question. What would be a good legal structure for workman's cooperative, each employees? I think money. Let's see if Ronnie.
Sure. So a workers' cooperative is basically a business where each employee of the business owns a share of that business. So what would be a good legal structure for that sort of business?
I need to sit down and have a longer conversation with you to be able to give a good answer.
Okay,
Uh,
all right.
Cooperatives are not-
I'll email you.
Okay. Kenneth asked, do you need to have workers' comp if your LLC designates your income as employee instead of sole proprietorship? Do you need to have workers' comp if your LLC designates your income as employee instead of sole proprietorship?
So I would say that workers' comp is, for your employees, you need it. For you as an officer, you may take an exemption, but if you have employees, you need to have it.
Okay, very good.
And Samantha, there's a form that has to be filed to claim that exemption, right?
Correct.
Okay.
Correct.
You have to file something with, is it the Department of Labor?
Yes, you have to file an exemption form with the DOL to get that exemption.
Okay.
Hi, good evening. I just wanted to chime in. My name is Sylvia Jetway. Ms. Winnie, may I chime in?
Can I do it when you're further down? I have some questions for you. Is it okay? Can you hold that because I'm coming up to you shortly. Is it okay?
Okay, sorry, I didn't put it in the Q&A in the chat.
Yeah, but I'm going to be calling you. You have something here on the Q&A, and when I call you, can you add it to that question?
Sure,
Okay.
I'm gonna mute myself now.
Okay. Ronnie asks, how does OSHA general duty apply to remote work?
Good question, Ronnie. The truth is that the legislators are still trying to figure that out. Remote work was not a widespread enough. The pandemic has accelerated a lot of things. And one of the questions is, okay, what does that mean for remote work? There's no definite answer yet. We're still a little close to this. So ask me again in 6 months.
That's a good idea. She went on to say, can you ask a potential employee their going rate? I think that answer was answered. The answer is, well, I think they did say you can ask the employee. I think he did say what range you would like to have, right? I think that's what you mentioned about
Right. If you're
yeah.
asking what is the employee looking for, the employee can tell you that. You cannot specifically ask, what did you get at your last place, or what have you gotten in the last 3 years, 4 years, whatever. That is prohibited.
Okay, very good. Sylvia, this is where you come in. You said,
Oh, thank you.
asked a question. It wasn't even a question, it was a comment. Yeah, so you can use that time to ask the question.
Oh, thank you. Well, I was about to put it in chat. Thank you so much, Wendy. Good evening, everyone. Yes, good evening, Thomas and Samantha. Thank you so very much. Very informative presentation. You can never learn too much. There's always room for improvement. My company is an LLC and I am in the construction industry, HVAC. So I'm very well aware what you have mentioned throughout the presentation. My question is, I was reimbursed, which is, quite odd, but which is good. I was reimbursed from New York State Department of Labor. They sent me a letter stating, due to the change, I think I went from partnership to LLC. that they owe me a reimbursement. So I did submit the letter and awaiting for my reimbursement, but they told me don't wait, hold on to my breath because the state is broke, so I may not get the reimbursement anytime soon. But I wanted to know, as far as changing the partnership from partnership to LLC, will this be an annual thing? Or this is just probably just a one-time thing that they just sent me this refund?
Samantha, I'm a little confused about this refund discussion, so.
Yeah, I can't really say unless I get a more context and maybe see the communication around it to see. Normally the refunds don't come very often, so I'd have to take a closer look at what they sent you in the communication to advise.
Okay, well, I had faxed over my statement, so they told me don't hold my breath because, obviously they say the state is broke, so, I'm in queue. But I'll be in contact with you if I could, email you the letter. But I just kind of want to know if this is a annual thing since I changed it to an LLC. Because I had reported to them as partnership, so.
I mean, the LLC is considered a
Partnership
partnership
to
with multiple
LLC.
members, so.
Right.
So I'm not sure. Yeah, I'm not sure what direction, unless you moved from one, where you're multi-member and you went to a single member, maybe?
No, we're all multi-member.
Okay, so I'd have to take a closer look at what they communicated to you.
Okay, yeah, because I did speak to them. I did speak to them in verbally over the phone. And then but I forgot to ask that one question, if that's something I'm going to look forward to every year. But, hey, when that refund comes in, I'll be glad to, take it in, but I'll be in touch with you. Just
Very
curious,
well.
that's all. Just curious to see. But thank you so very
Sure.
much. All the things that you mentioned, as far as, in the construction industry, which I am in, we do get single-handedly. This is why, I cross my T's and dot my I's, when it comes to, having full workers' comp, paid medical leave, the works, benefits for my employees, because I like to sleep at night. So, in the construction industry, it's a very, scary, industry. So if there's no shortcuts. So very well
Right.
stated, as a wake-up
Okay.
call for those who want to come into this industry to not, to do the right thing.
Very good. So we have a couple more. We have Jean asking, what would be the biggest challenge as a S Corp to receive the PPP?
Oh, Samantha, that's all you. I have stayed away from that stuff like the plague.
Can I hear that question again, Winnie? I'm sorry.
What would be the biggest challenge as a S Corp to receive the PPP? I could even answer that.
Oh, yeah.
But go on. And that's because
I mean, it's
my
the payroll.
question is that I did not create a W-2 for myself, and that's why I was exempt. But if there's any other challenge that why a S Corp will not get a PPP, you can chime in there. But I knew that was the number one thing that disqualified me. But
You hit the nail on the head. That's really what it was. That's
Yeah.
really what it is. The payroll has to be run. If you remember what I said earlier, the expectation is that corporate officers pay themselves a reasonable salary.
right.
And when that doesn't happen and all the money flows through on a K-1 with no payroll taxes, it's going to be
Just as an investor.
right, just an investor and not an employee.
Mhm. Yeah, so I learned my lesson, okay? So I am done now. Okay, Kenneth, let me ask, Jean, that's okay? You got the answer?
Yes, Winnie, thank you. I appreciate it.
You're welcome. Yeah, so we all who have S Corps, get yourself a W-2, okay? Put yourself on payroll.
Okay.
Alrighty, Desmond, I don't know if I missed this, so I would like to know what is the main reason many small minority LLC business owners cannot get New York State MWBE certification? I think, yes, you missed it. The main reason why is that they did not file they did not have the publication filing, and that publication is critical. And they just said it, if it's not done and the state doesn't get it after a period of time, your business no longer exists. So Lady Thomas or Samantha, you can tell me if, because I know that's what both of you just said, but you can repeat that question for him. The main reason why many small minority LLC business owners cannot get New York State MWB certification.
So I haven't actually come across, I know that you have though, Winnie, where
Yes.
you've had folks who couldn't get it because of the publication. I haven't come across that. I would say most times it's, you know, it's paperwork. You know, they ask for a certain documentation.
Mhm.
So if you don't have the paperwork, then you won't be able to clear the hurdles. But most of the things they ask for can be, you know, you can get them. For
Mhm.
example, you know, if you're a corporation, I'm not an LLC per se, and you don't have stock certificates, you can get a corporate kit. And
Yes.
from that kit, you can then fill out the stock certificates that you can use. So if you need help with that, I believe Marls has resources in-house and
Yeah.
partners that they work with to kind of help you navigate through that process.
Yes. Yeah.
Winnie, this is a good opportunity for me to draw the distinction between formation and organization.
Yes.
Because the formation of your corporation or LLC is really just the beginning. There are
Mhm.
7 or 8 steps, maybe a little bit more, that have to be taken to completely organize. And Samantha just alluded to 2 of them, getting a minute book or corporate kit. You know, you can get a minute book for $65. So it doesn't have to be fancy or expensive. You just need a good central place to keep all your corporate records. And like Samantha
Right.
said, you want stock certificates, you want bylaws, shareholders agreement, or your operating agreement if you're an LLC. You want a stock transfer ledger so that you have a list, a running alphabetical list of who the owners of your company are and what their percentage ownership is. You want the resolutions that Samantha alluded to earlier too, putting your officers in place and accepting the capital contributions and that kind of stuff. There really are at least half a dozen steps or more that have to be taken after you file the articles of incorporation or the articles of organization. And I like to point out that's one of the differences. That's one of the big differences between what Samantha and I do and what the online companies do. They don't give you those extra 7 steps.
Mhm. Okay. We have 2 more, which should bring us to 9 o'clock. One is from Althea. I am a 1-member LLC and have a filed workers' comp exemption. Is it something I have to do yearly or only have to change when I have my first employee? I am a 1-member LLC and have filed workers' comp exemption. Is
So
it-
I don't think it's yearly, but you know, at the time that you do your annual, have you done an audit? I mean, you may not be doing one if you're exempt, but you know, definitely, and whenever, as soon as you have an employee as a prospect, you need to go back, put that in place before you add them to payroll.
Mm,
Is when you would want to get that worked through.
Okay, thank you.
You're
Okay.
welcome.
And Gracia says, I have okay, that's just a comment. She says, I have publishing and it's still difficult and lengthy. Yeah, well, you know, it's a process. It's the byproduct of the desire for LLCs, and and it comes with the benefits. If you have good managerial processes, because that's what I would say, you have to really have a good management system. I think the LLC could work for you for many, many other benefits that it does offer. And I think in making sure you sit with your accountant and really get clear about what your vision for your business is, how are you planning to scale it, and where you plan for it to end up? Because how you start is starting the business with the end in mind. To me, that, you know, any of the professionals here can correct me, but I believe in starting your business with the end in mind. So as you go through the process, both your lawyer and your CPA are best able to guide you correctly as to the formation you should have or the structure. But I believe you can amend that later if you change your mind and you want to do something else. Yes, Thomas and Samantha, they can
Yes, absolutely.
Structure, right, okay. Yeah, so that ends our questions for tonight. We finished exactly 9 o'clock. I want to thank each and every one of you again, yes, for actually learning. And they did it nice and slow, so it was not overwhelming, but it's a lot for you to think about, okay? Think about your websites, think about your structures, think about your filing, do not go the cheap way. I'm telling you, okay? When I train in business, I say if you're in New York and you're making $1 million in revenue, is considered business poverty. It is business poverty. If you're in New York, 1 million in revenue is business poverty because you have too many things, you know, that you notice when Tom says that the larger companies have protection. That's what you need. You need to have protection. You have to have these monies set aside to protect you, to pay your lawyers. Okay, those of you who remember watching the soap opera Falcon Crest, you remember Falcon Crest? Angela had her lawyer at her side each and every